In this video, I'll be revealing the 5 safe assets that secretly make you poor, investments that may seem secure but are actually working against you. Through working with hundreds of retirees, I've seen a cruel irony. People who thought they were investing to protect their wealth, they were actually doing the exact opposite. And that's why I'm making this video today, to expose these wealth traps and show you better alternatives that actually preserve and grow your money. Let's get right into it. And the first one might surprise you because it's something that most people view as the foundation of financial responsibility: savings accounts. And for emergency funds, they absolutely are. But here what catches even smart investors off guard. When you hold large amounts in savings accounts beyond your emergency reserve, you're guaranteeing you'll become poorer every single year. Now, you might be thinking, but my savings account actually pays over 4% today. But here's the reality. Banks aren't charities, and your interest rate is just a representation of just keeping your chin barely above the water of inflation. And after taxes on that interest, you're practically drowning. At an average inflation rate of 3%, your money loses half of its purchasing power in just 24 years. That cart full of groceries that costs you $150 today will likely cost you $300 for the same items 2 decades from now. So if you're 60 years old today with 200 grand in savings, by the time you're 84 years old, those same dollars will only buy you 100 grand today. Now, you might be thinking, but at least my principal is safe in these accounts. And nominally, you're true. Your account statement will show you the same number. But you're trading the possibility of temporary market declines for the certainty of permanent purchasing power loss, which means less travel, less support for your kids and grandkids, and more financial anxiety year after year. This problem gets worse when opportunity cost enters the picture. I see this pattern frequently where people may receive an inheritance, sell a property, or have concerns about the political environment and move to cash temporarily. But temporary becomes permanent because they're waiting for the perfect moment to get back in. For example, I recently worked with a gentleman I'll call Tom, who had sold his business in 2020. He received a significant windfall, over 750 grand, and parked it all in savings accounts. And it wasn't that Tom was overly conservative by nature, he was just overwhelmed by having that much cash at once and not having a plan for it. Years later, we sat down to build a plan for him, and unfortunately his cash had been bleeding purchasing power while the market delivered strong returns, making his opportunity cost exceed 6 figures. But after watching the market climb month after month, Tom's regret of inaction compounded, and he continued to wait for the perfect moment to invest that never came. It's a painful decision of how indecision itself becomes a decision. But if you think savings accounts are problematic, wait until you see how the next investment takes that same problem and locks you into it for years. Fixed annuities are often marketed as the ultimate safe retirement income solution, but they lock your wealth into poor returns while delivering 2 other devastating blows. The first blow is their fees, which are often buried and unclear. Surrender charges, admin costs, mortality and expense charges, these just eat away at your already modest returns. I've reviewed countless annuity contracts where clients thought they were getting, say, a guaranteed 4% return, just to discover that after all their embedded fees and costs, their actual net return was closer to 2%. During a period where inflation was running at 3%, they were still losing purchasing power. They just locked themselves into doing so for years. And the second blow of fixed annuities is how they eliminate your ability to adapt to changing circumstances. In retirement, circumstances change. You might need access for funds for healthcare, help a grandchild with college, or pursue better investment opportunities. With fixed annuities, surrender charges and restrictions prevent you from flexibility that is worth more dollars than you'd think. And remember, annuities aren't investments. They're insurance products built on providing certain guarantees, and there's always a catch when a certain guarantee is involved. The complexity of annuity products often hides their true costs and limitations. They only become apparent only after you've committed, when the surrender period stretches years into the future and you realize the guaranteed income doesn't keep pace with your rising expenses. Now that you've seen how some of these conservative investments quietly destroy wealth, if you're ready to optimize your investment strategy and protect your financial future, click the link in the description to book a call with me, where I'll give you personalized advice for your situation. Now, you might think these things couldn't get more deceptive than annuities, but this next option creates the illusion of earning decent interest, but hurts more than it helps. Similar to savings accounts, but often paying higher rates, certificates of deposit still aren't helping when it comes to beating inflation. CDs have this aura of safety. They're FDIC insured, they pay higher interest than savings accounts, and they feel responsible. But here's the reality. They tie up your money while virtually guaranteeing you'll lose that purchasing power. As I mentioned earlier, we've seen elevated rates over the past few years, with CDs paying 4, maybe 5%, which sounds pretty good compared to what we got for the previous 2 decades. But here's what makes that deceptive. Look at what inflation has done over the same period. Over the past 5 years, for example, we've experienced roughly 24% cumulative inflation. That means prices have risen by nearly a quarter. So, yes, your inflation may be paying you 4% annually, but inflation has been running at similar or higher rates during much of that period. CDs continue to do what they've always done, barely keeping up with inflation at best and more often falling short. But I do want to be clear, CDs, I feel, have a place, albeit a small one. For specific anticipated spending goals within the next 2 years, they can work well. But using CDs for long-term retirement assets often proves counterproductive for wealth preservation. But here's the key issue that ties savings accounts, annuities, and CDs together. In retirement, you're simultaneously fighting two battles that threaten the concern of running out of money. The first is what the media wants to remind you about all the time: market volatility. You address this with stable investments to weather downturns without being forced to sell at the worst possible time. And the second battle, one that's far less discussed, is inflation that we've been talking about. The silent tax consistently erodes your purchasing power over decades. And now, while CDs at least have a clear purpose if used correctly, this next investment claims to be sophisticated and automatic, but treats you like you're identical to everyone else your age. Target date funds have become the default option in most workplace retirement plans, like 401ks. They're marketed as the ultimate set it and forget it solution. You pick your retirement year, and the fund automatically adjusts your allocation as you age. But here's the problem: they shift too conservatively, too early, using a one-size-fits-all approach that ignores your individual situation. For example, last week I helped the daughter of one of my clients who's in her early 30s, decades away from retirement. When we reviewed her 401k, she was invested in a target date fund that already had her allocated over 10% in bonds. For someone who won't need this money for 30 plus years, having one out of every $10 in bonds is questionable. But here's what's worse. Each year, that fund would automatically become more conservative, shifting to more and more bonds, whether it aligned with her goals or not. So after discussing her specific situation, we moved to a diversified all-stock allocation. And that adjustment alone could potentially add 6 figures to her retirement wealth over the coming decades. But the same issue applies to the other end, people within 5 years of retirement. Most of the time, I find that clients have been too conservative for too long. Their target date funds have been gradually reducing stock exposure based solely on age, leaving well over 6 figures of potential growth on the table. This often causes them to either work longer than necessary or spend less in retirement than they could have otherwise. Think about it. What are the odds that a cookie cutter, one-size-fits-all allocation is truly appropriate for your specific situation? Your target date fund doesn't know if you have a pension, your social security strategy, your healthcare costs, or your spending plans. It just knows one thing: your date of birth. Imagine if the only thing a doctor asked you before writing you a prescription was your age. Would that give you the confidence that it would be the right medication for your needs? The transition from growth investments to conservative investments is crucial. It's like an airplane landing. You would want a smooth, intentional approach to the runway, not a sudden drop. And that's where target date funds attempt to create this smooth transition, but they're just far too simplistic, over-rotating to fight volatility while surrendering to inflation, sacrificing growth over decades. But this final investment fails for the opposite reason. It seems sophisticated because of its tax benefits, but in reality, most people don't need what it's selling. And you may have heard of it: municipal bonds, or muni bonds people call them, which are unique because they're exempt from federal taxes. But for most people, they deliver mediocre returns that often don't justify giving up higher yields elsewhere, even after accounting for the tax benefit. And while there are situations where it makes sense for, like, say, high earners in expensive tax states like California and New York, you have to ask, are you actually in that tax bracket during retirement? During your working years, when you're earning a W-2, high tax brackets make muni bonds attractive. But in retirement, your tax picture changes entirely. You control when you take distributions, how much, and from which accounts. I see it be very common among clients that their taxable income in retirement is substantially lower than during their career. Unfortunately, investors who load up on muni bonds during their high earning years stay in cruise control and continue holding them in retirement out of habit, not reassessing whether the tax benefits justify the opportunity cost. So, those are the 5 safe assets that secretly make you poor. But before I show you what can work better, I want to show you what this costs you in real terms. Over the past 30 years, the purchasing power of the US consumer dollar has been cut in half due to inflation. But the S&P 500, shown here in blue, has gained 888%, even after adjusting for inflation. That's an 8% real return per year. This is exactly why smart planning to evaluate those safe assets is vital to help you actually grow wealth in real terms despite inflation. Now, let me show you 5 things that might protect and grow your wealth instead. First, right size your cash reserves. This means evaluating what is an appropriate emergency fund for you, typically 3 to 6 months of expenses. And beyond that, consider setting aside cash for strategic debt paydown and any large anticipated expenses over the next 2 years, things like replacing a car or a major home renovation. The key is to measure twice and cut once. Calculate what you actually need for liquidity and near-term spending, then be intentional about keeping just that amount safe and accessible. But money beyond those specific purposes, that's where you might consider growth investments. Second, consider more flexible alternatives instead of fixed annuities. Diversified dividend-paying ETFs, for example, are true investments that can provide income while maintaining growth potential and giving you the ability to adapt to changing circumstances. Third, for temporary cash parked beyond your emergency fund, short-term treasury ETFs can offer comparable or better rates potentially than CDs with more liquidity and no early withdrawal penalties. You're just cutting out the middleman. Fourth, consider customizing your retirement portfolio allocation based on your actual income plan, not a generic target date fund. Your allocation should reflect your specific withdrawal needs, income sources, time horizon, and risk tolerance, not just your birth year. It should be tailored to you specifically. And fifth, it may be worth reassessing your muni bond holdings if you have them based on your current retirement tax picture. If you're not in the highest brackets, quality taxable bonds or dividend-paying stocks might provide superior after-tax returns. Each of these recommendations is powerful in of itself, but when combined and implemented together, the synergy can make a life-changing impact on your net worth, especially when considered across the span of your retirement. This right balance depends on your specific situation. So now that you understand the 5 safe assets that secretly make you poor and the alternatives that might actually protect and preserve your wealth, you can make investment decisions based on real wealth preservation so you don't let the illusion of safety become your greatest retirement risk. True safety in retirement means preserving purchasing power, maintaining flexibility, and fighting both the market volatility and inflation effectively. And if you're failing to plan for that, well, you're planning to fail. If you're ready to get professional guidance on optimizing an investment strategy and building true wealth protection, click the link in the description and book a call with me. Thanks for watching, and I'll see you in the next one.